Guys, I'm here at our monthly lunch and learn. I'm giving a presentation today. We're going over the market for the past year and then looking ahead to this next year. Every month we give a lunch and learn presentation to give education for our clients. Maybe it's a tax item, maybe it's Medicare, maybe it's identity theft and fraud like next month. But this month we're covering the markets. We're going to have some awesome topics that we're covering today. I know that you can't be here and wish that you could. We have good attendance. But I'm going to go ahead and record this presentation for you and I'll send it out to you. We'll see you at the next one.
This presentation is for informational and educational purposes only and should not be relied upon as a basis for investment decisions. Clients of Client First Investment Management may maintain positions in the securities discussed in this presentation.
Here we go. We're going to jump into one of the presentations we give on a quarterly basis. My name is David Zarling. I'm the head of investment strategy and research here at Client First Tax and Wealth Advisors. Every quarter we dig into the markets, we take a look at what took place, and then also some insights we have using our Adaptiv Investment Management System. We do a monthly lunch and learn presentation. Next month, for example, we're going to be doing a presentation on preventing cyber fraud. You might want to attend that. But every month we give a different topic that we cover. It's the third Wednesday of the month over the lunch hour. Typically how these work, it's a live presentation. You're obviously seeing this recording, but the live attendees have the benefit of enjoying a lunch or a beverage or something to eat or drink, whether it's during our lunch session for most lunch and learns, these market review presentations. From time to time we have a special evening session that we also have, and these are located near our location in West Bend. You can call in for details if you need them, but before I get too far into the presentation, I think it's important to point out some new and exciting information we have regarding Client First. The first one being Renee Berg, our expert for tax. She's now an enrolled agent. This is a huge deal. She put a lot of effort into this. There's been a lot of enhancements and investment back into the company in order to make it more efficient for our clients. And we also invested in our personnel, and Renee definitely has done a tremendous job. She's passed. These are some tests that take a long time. They take a lot of effort, a lot of study, special study sessions where she has to travel across the country, go for a week-long study session, and then taking these tests. These tests can last half a day to a day. What this really means, what does it mean to be an enrolled agent? She's now authorized federally. She is now able to represent our clients at all levels of the government, and that's important when we get into tax planning, tax preparation, tax filing. We're very, very proud of Renee. This is a value add for our clients, and we're excited about it. Also want to let you know about Chris Walla. He just joined our firm. We found that our clients, when we go do our holistic planning with them through the bucket planning, we've identified obviously it's important to have a holistic approach or a complete picture approach. And one of the things that we identified is the need for a property and casualty solution. And, think of your auto insurance or your home insurance. Chris is going to be heading up that for us. He's got a long experience, 10 years in the industry handling that. Obviously you can contact us if you need to talk to him, but we're excited about Renee's accomplishment and Chris joining our team. It helps us increase our ability to serve our clients. All right, so let's dig into this thing. Dig into some of these annual market insights. We can talk about 2016. We'll go ahead and cover the agenda here. We're going to go over what this last year looked like. It was one for the record books. We'll look at the power of January. There's some interesting tendencies in January that you might find interesting that give us some insights into the rest of the year. The topic du jour, we'll look at President Trump and what that means for the market. Of course, we'll go over some important sectors and what we're seeing in international markets as well as commodities. We're also going to take up an important topic, volatility during bull markets. This is an important one. What does it look like when markets rise and there's volatility? You can have volatility that's dangerous and to the downside, and you can have volatility that's really important and you want to ignore to be able to capture gains to the upside. And this will be an important topic for us to cover. So I like to use memory jogs or things like that. We have a lot of information today. I'm going to be throwing a lot at you guys. Maybe you've got, I suggest maybe this presentation is going to be about a little less than an hour long. So the beauty of having a recording, you could pause it and come to it later. Otherwise, grab a drink, grab something to eat, sit down. I like to use memory jogs. Here's this guy drinking some coffee. This reminds me, obviously that's not me. I don't have quite the awesome hair there and the mustache. But this guy reminds me of a conversation I had with Justin when he was inviting me to join him here at Client First back in December of 2015. We were having coffee together, and I just told him point blank, you're asking me to join at a time when do you realize that 2016 could be a very rough year based on some of the things that I study, and the reference here of saying the evidence suggests 2016 might be a sticky wicket. Sticky wicket is not a common term that we use, but it's a piece of foreshadowing for later in the presentation. It's a common phrase in the United Kingdom, but we'll get to that in a minute. But let's jump into what 2016 was all about. If you remember, looking at the market this past year, the first week in January, the Dow Jones lost almost 1,100 points, 6%. It was the worst start to a year on record. And if you're not sure, the Dow Jones goes back to 1896 when Charles Dow invented it. So here the Dow Jones, worst start in over 100 years to a stock market year. Oil in that first week of January records the lowest price since 2003. That move since the middle of 2014 erased $1.1 trillion from the S&P 500. When you think about the different sectors within our economy, one of the bigger ones is energy, and when oil loses value, that affects energy companies. This picture on the bottom here, we're showing different predictions, and this is again foreshadowing here. We've got Goldman Sachs, Morgan Stanley, both predicting by the end of 2016 oil will be $20. Standard Charter is predicting it's going to be $10. So this is all happening in the first week of January. Mid-January, George Soros says, "This reminds me of 2008. For all of us, that kind of jogs something in us, right? There's something in us, in our brains. We've been around long enough that we can remember 2008 and the pain that it caused. And so when someone like George Soros, who I think most of us know, says something like this, it can cause a little trepidation, a little bit of fear. RBS tells clients to sell everything. So here we have a huge investment firm, a huge financial firm telling its clients sell everything. And just for some context for our own clients, at this point in mid-January, we did not have heavy exposure to the market. We were market neutral with a large cash position and a large market neutral position. That had been in place since July of 2015, and for good reason, because our system indicated that was appropriate. But here we have RBS telling their clients, this is a deflationary crisis, get out. Early February, S&P 500 at 1810. That's a minus 11% start to the year, and that's 15% down from July of 2015. So if you can envision it, July 2015, the S&P 500 tops out. Our system's able to identify to be out of the market, reduce exposure. We have some volatility to respect, and from that point forward, the market has dropped 15%. For the NASDAQ, we're at 4209, minus 16% start to the year, minus 20% from July of 2015. So a lot of selling, a lot of panic. Oil is at $26. Hadn't seen that price since 2002, which is 14 years ago. March, S&P near 2,000 records the largest 10-day gain ever. Oil is near $40, 50% gain since January. April and May, S&P 500 back near 2015 highs. So we're almost back to July 2015 highs. 11 months, we're still 2% below those highs with a 15% drawdown. So basically in 11 months, we're down 2% in the S&P 500 with volatility or a deviation of minus 15% from that level. Oil reaches $50, still 15% below 2015 highs. 20-year treasuries are near $133. It's the highest treasury prices ever recorded. And I have this little visual here in the bottom of the screen. This shows us, bonds, when they increase in value, when they move up in value, yields drop. So bonds up, yields down. And so here we have the highest treasury prices ever recorded. This tells us these are also some of the lowest yields ever recorded. June. Maybe you guys remember this, and this is where my foreshadowing comes in, talking about a sticky wicket. The United Kingdom votes to leave the European Union. You might have heard it on the news, called Brexit. And just for your information, they voted for Brexit. Brexit itself, as an event, has not happened yet. That's still something that goes through the EU Parliament as well as the UK Parliament on the best way to exercise that vote or exercise the actions of the desire of that vote. So the Brexit hasn't happened, but obviously the market's a future looking discounting mechanism, so we can identify that the market will react to such events. After that vote, the Euro Stoxx 50 index, this is very similar to our Dow Jones 30 index, or the Dow Jones, so it's Europe's largest 50 stocks, drop 8.6% the day after Brexit. That's the worst one-day drop in 30 years. Another historic event. Yet we note that the London Financial Times exchange is up 2% 1 week after the vote. That should kind of give us a little clue here. But so we see that Europe 50 is down 8.6% in a worst one-day drop in 30 years, while in the United Kingdom they're experiencing appreciation after the Brexit vote. S&P 500 drops 5.3% in 2 days. It's a 0.3% deviation event. This just means it's extremely rare. I do remember talking to an individual that I talk to often who's been in the industry for over 30 years, and he had not seen something like that. But it is very rare. After the 2-day drop, S&P 500 records the largest 10-day gain ever, and you might say, hey, wait, you said that previously. You said that that's right. So there was two in the same year, 2016. There were two huge 10-day gains. The headlines after Brexit. Here we have Los Angeles Times. Did Brexit voters just walk Britain off a cliff? Chicago Tribune. Brexit vote a disappointment that will shake the world. New York Times. This is just the start of Brexit's economic disaster. July. S&P 500 finally records a new high. So here we've gone from July of 2015 to July of 2016, and we're finally reaching new highs. So basically a 0% return with a 15% drawdown. 20-plus year treasuries are at record highs. Oil, however, is back below $50. August, October. Crying Brexit in a crowded theater. That's my way of saying since the Brexit, the London Stock Exchange is up 11% since the Brexit vote, despite all the headlines and fear out of newspapers and websites and news agencies. S&P 500 is in ultra-tight range since Brexit. It trades within a 3% range of all-time highs for 79 days. It's the tightest range in 22 years since 1994. In September, there's media panic over Deutsche Bank. You may or not remember this, but they were harping on this. It's one of Europe's largest banks, and at the time it was trading at $11, and there was a lot of fear over this. In fact, I presented on it in the fourth quarter market review in October. We talked about what it would mean if Deutsche Bank went to zero or went bankrupt, and our thoughts on that. and whether or not it might happen. Just an interesting period to watch the media cover Deutsche Bank. During that same time frame, I think we all know who this is. Time magazine says Donald Trump is in a meltdown. November, this is the same chart I presented at the October Lunch and Learn market review, and basically we know that the market has does a decent job of giving us some insight into elections, and it basically works like this. When we look at data going back to the early 1900s, we see that if we just look at the 3-month period leading up to a presidential election, so just the 3 months leading up to a presidential election in November, when the S&P 500 is up during that 3-month period, it's likely that the incumbent party will win. It's an 86% chance. In the opposite scenario, if the market in that the S&P 500 in that 3-month period is down, the challenging party stands an 86% chance of winning. So here we have, leading into November, the stock market giving us some indication, and here is the real meltdown. This is the 3-month period leading up to the election. The S&P 500 is down 2.26%. As we posted on, if you don't follow us on Facebook, we posted a video on there. You can check us out on there and like us or follow us. We posted a video on there indicating this information, and just not that we were hoping or whatever or picking Trump to win, but that the market was indicating at that time that there's a strong possibility that Donald Trump could win the election. And here we have the S&P 500 down heading into the election. Yet we have headlines showing us that Trump's going to need a miracle. New York Times is telling us why Hillary will win. CNN is saying a key model predicts big election win for Hillary Clinton. Yet we know Donald Trump was elected 45th President of the United States. Whatever your leanings, I'm as agnostic as it can be. I don't have an opinion necessarily one way or another. I think it's important to vote on values and principles, but when we look at the market data, sometimes people do vote based on emotion, based on their pocketbook. When the market's down and leading into an election, maybe it's an indication that there's some dissatisfaction or voting with the pocketbook. But here we have Donald Trump elected as the 45th President of the United States. I don't know if you guys remember that night, but the S&P 500 and Dow Jones both recorded the largest point drop ever. Limit down was enforced in the overnight futures. This works like a circuit breaker, similar in your house. If you plug too many things into one outlet, it's just an overload. The circuit breaker trips, and it disallows anything getting damaged. Similar to the market that night, these huge drops on the night of the election forced a limit down, no trading. And if you remember the bottom right hand corner of any channel you were watching, they were showing it. They were showing the Dow dropping, and I would say because it generates views. Is it newsworthy? Yes. However, maybe it's just covering a little bit too much the panic side of things. This is what it looked like on that night. Here we have the futures, this large drop on election night. There's lots of fear from people in the market, and we quickly rebounded the next day and moved upward. And regardless of your opinion on who is president or who could have been president, personally I think, and there's no way for me to prove this, but that the market would have had a similar response if Hillary had become our 45th president, because really, if you think about it, the market will take as much certainty as it can get, and really, we had it narrowed down to 2 individuals going into the election, and is basically a coin flip. Money may have, or allocations may have shifted. We're going to get into some detail here on how the money settled, or the dust settled after Donald Trump's election. Maybe the dust would have settled a different way if Hillary was elected, but it's likely that the market would have responded similarly. And here we have Time, who previously said Donald was in a meltdown, here now calling him Person of the Year. Going through November and December to wrap up the year, long duration bonds and treasuries sell off. 20-year bond, if you remember, those were at their highest back in the middle of the year, and now 20-year bonds record the largest drop since 1986. It's one of the largest yield changes in history. Small caps rocket up 20% in 26 days. It's the largest move for the Russell 2000, which is an index that covers 2,000 small cap stocks. It's the largest move since 2009. And if we can think back to that time, 2009 was a bottom in the market, and typically small caps will lead off a bottom. So here we are with small caps now making a huge move as if coming off a bottom. Oil closes the year near $53, up 100% since February. The London Stock Exchange up 26% since the Brexit vote. 2016 was a sticky wicket. It was a crazy year. It was exhausting. A lot of historical moves, a lot of volatility. It was definitely an interesting one. Lessons learned. Here I just want to cover some of the headlines that we got from popular media, whether it's mainstream, Yahoo Finance, CNBC, New York Times, etc. How did these predictions work out? So here we have oil predictions that I pointed out at the beginning of the presentation. Goldman Sachs and Morgan Stanley saying oil is going to be $20. Standard Chartered says oil is going to be $10. But yet by the end of the year, oil's at 53. RBS tells clients to sell everything as deflationary crisis nears. S&P gains 9% from that point. Oil's up 45% and Treasuries plus 2%. New York Times says this is going to be the start of Brexit's economic disaster back in June. What did it do since then? London Stock Exchange up 26%, finally above 1999 highs. So think about that, 2016 finally breaking above the 1999 highs. So the market had gone sideways for over 15 years, and I don't think it's coincidence. And I'll point out, I know when I gave the live presentation I talked about, did anybody know when the euro was introduced? So here the United Kingdom's voting in June to leave the European Union, leave the euro behind, and it's breaking out to highs not last seen since 1999, and the euro was introduced in 1999. I don't think that's coincidence. Here we have Deutsche Bank and the media freaking out about its stock price and whether it was going to go bankrupt. I'm not saying that those aren't legitimate concerns, but it does point out maybe how the media operates. Deutsche Bank from that point forward moved up 65%. New York Times says Hillary tells us why Hillary will win. Later on, media lets us know that Donald Trump is their person of the year. So what are our lessons here? What are we learning? What are we seeing when we deal with popular media in their coverage of the markets? Really, we need to understand that markets drive news, not the other way around. So whenever you see a headline like on Yahoo Finance or CNBC where they're saying something along the lines of, oh, oil moved up 2% today because of, I don't know, inventory dropping at Cushing in Oklahoma. Well, that may or may not be true, but we don't know that for sure. The truth is that oil moves up in value when there's more buyers than sellers. But that's not a sexy story, so they won't write it that way, but that's the fact. There are more buyers than sellers, price moves up. When there's more sellers than buyers, price moves down. So when markets move, they drive the narrative, not the other way around. The other huge and important thing we need to remember here is we do not need to predict to invest. Goldman Sachs predicting $20 oil, RBS telling us that things are, are going to go down because of a deflationary crisis. We don't need to predict in order to participate in markets. We can use price, we can look at supply and demand and understand the dynamics of that in order to capture gains when we should be in the market and avoid losses when we should be out. And really, by the time we know why, it's too late. By the time a price movement happens and we look back and find out the real fundamental reason why, it's too late. And so we need to use price as our leading indicator rather than the news, which really, I would argue, has a conflict of interest, because really what is the purpose of media? Yes, it's to inform. However, they also have another interest in mind, and that's selling advertising. So will it sell a lot of advertising if they tell you that there's more buyers than sellers or more sellers than buyers? No. But if they sensationalize things for us, it makes it entertaining, it makes us something we want to watch, and we get influenced by it, and they're able to sell more advertising. There's a conflict of interest there that we definitely need to be aware of as investors. Here's a piece by Charlie Bleo. He's an asset manager that I'm a fan of. He wrote this piece a while back, and I wanted to share some of it with you because I think it's very important to understand the difference between a pundit and a professional. The pundit spends their days making subjective predictions. The professional spends their days making objective assessments. The pundit is forever calling for the next big melt-up or crash. The professional is forever focused on avoiding the next big mistake. The pundit makes a living selling fear and greed. The professional makes a living helping to control these emotions. The pundit makes extreme forecasts to gain attention. The professional anticipates wide ranges of outcomes to gain respect. The pundit has a prediction, the professional has a plan. So which one is it? Which one should we follow, the pundit or the professional? There is a choice. And for us and for our clients, we choose to be subjective, or I should say objective, and we study price and we use the Adaptiv Investment Management System. Rather than making subjective predictions, we have objective plans and we adjust to the market accordingly using this system. It's an important distinction. We do not need to predict to be in the market. And we know investors would love a straight line. If we could grow assets in a straight line, that would be the ideal world, but we also know we live in a market's reality. Here we have the pitfalls of a market and how it operates. Here we have a guy that's in this fishing hole here, and there's a storm over here, and that's really the market of the reality of the market. And here we have the S&P 500 going back to the beginning of 2015, right? And we can see this drop of 12.5%. The reality of the market, minus 15%, and then finally a reversal. And this just gives an illustration of how our system works. How does the adaptive system work in this type of environment? It's not a perfect system, and I don't want to give any allusions to some type of holy grail. And frankly, if you're talking to anybody that tells you that their management approach goes up in value each month, you should probably run, because it sounds a lot like a Bernie Madoff Ponzi scheme. But the way this strategy and system works is it's adaptive. We use price and trends and data to guide us in our decision making. We don't have to predict. We can use price to identify when is there volatility that we can be a part of and make gains, and when is there volatility that we need to respect and be out of the market. And in this example, the system had our clients in the market the beginning of 2015, exposed to equities during that time, and our system identified that there was too much risk entering the market, too much volatility, and we were able to identify that during this period to be out of the market. So this period where there's these drawdowns of 12%, 15%, and we know that they can get much greater, we're no longer exposed to equities. In fact, I'll show you here where the system will lag the market, and that's where we have these transition periods. It's during this period here that I just highlighted that the system, the data that we're using indicated that the market actually may turn down harder. This is Brexit right in here. This is the Brexit vote, and this is when the system indicated that we could actually take a position that would profit from the market dropping. The other way to look at that, though, however, is if the market rises, that position will drop in value. So during that period, the system is lagging behind the market, yet it's able to identify during this period, as we are now, our clients can be exposed to equities, and it's a safer environment to be involved in. So really, when we look at this 2-year period, we can see that the system is giving us a green light to be in equities during periods where there's not significant volatility. And what we're doing is we're reducing, not completely eliminating volatility, but we're reducing those drawdown periods. That minus 12.5% drawdown and minus 15% drawdown, our clients didn't experience that. They didn't have to go through the emotional toll or the loss of value that happened during these periods in late 2015 and early 2016. Remember, 2016 had the worst start to the year, and our clients didn't have to experience that because of the adaptive system, using objective price as our guide. On a bigger picture illustrating this system again, exposure to equities when the system would identify to be in or not in or exposed to the stock market. This might look familiar to you. This is the New York Stock Exchange going back to 1996. Here we can see the dot-com bubble roll over in a loss of 40%. Here we can see the great financial crisis, 2007, 8, 9, loss of 60%. Here's 2011, minus 25%. And here's the drawdown our clients did not experience of minus 21% down in here. And this just gives us an idea of where the system would say there's too much risk, we don't need to be involved. However, we need to understand that just looking at this, it looks like, oh man, this is pretty easy, but it still needs to be understood that even though you're in the market, periods like this, where we have some drawdown, that's going to be normal. But at the same time, we're going to have to manage our emotions, and that's one of the privileged roles we have here at Client First is standing between you and the markets and acting as your emotional bodyguard, helping you understand how the system works, how it operates, and that we can be exposed to this volatility. Be exposed to this volatility to capture these gains. And when the system indicates we need to be out and avoiding any type of capital loss, we'll do that as well. So in the end, it's a system that's not perfect, but it's a system, and it's a system that will have drawdowns and loss. However, in the end, it smooths out and avoids some of these bigger areas of market volatility in order to smooth out that line as much as possible towards your goal. In the Adaptive Investment System, Management System, the AIM system, the longer the period of time, the more likely it is to outperform the market. So it's a long-term solution. This is not an investment management system meant to outperform on a daily, monthly, or quarterly basis. More often than not, however, about 9 times out of 10 or 9 years out of 10 years, it's going to do well. It's going to outperform the market or equate with the market. So the longer you're involved with the system, the greater the likelihood of outperforming. So what is the Adaptive Investment Management System? It's a means for identifying major market themes as far as which sectors or areas are leading the market. It's adaptive, it's tactical, it's based on price. It's not based on my subjective gut instinct or something maybe Justin saw on TV. It's really based on data, hard data, and long-term themes of strength. And we don't use it to predict because we don't need to. Let's jump into the power of January. Kevin and I had a discussion. He's our customer service support He does an awesome job. We were having a conversation about January, and we both agree that correlation does not mean causation. You've probably heard that term before, but it does show implication. And January has some interesting characteristics about it that I kind of wanted to show you guys and highlight. The first 5 days in January, this one's interesting. It's got an 85% hit rate. 35 out of 41 years when the first 5 days of the year are up. The average gain for the S&P 500 for the remainder of the year was about 14%. That's pretty good. 85% accuracy with a 14% average 14% gain. Less reliable, however, is the other way. Is if the first 5 days are down. It's a coin flip. It's about 48% accurate, and the S&P does generate a lower average annual return when this happens, but it's a coin flip on whether there is a negative return or a positive return. Whereas if the first 5 days are positive, it does have some implication to it. So I know what everybody's wondering. What was the first 5 days in January of 2017? We were up almost 0.5% in the first 5 days. So there's some implication there for the rest of the year. Another important indicator or implicator is the January Barometer. When we look at the S&P 500's performance in January, going back to 1950, every down January, with one exception, and of course that had to be 2016 because 2016 likes to be in the record books. But every year since 1950, if the January's performance was down, it preceded a flat market, a 10% correction, or extended bear market, and really with an average annual loss of 14%. So if January is down, you can there's a pretty high implication that the remainder of the year could be down as much as 14%. Nothing is guaranteed, but it's definitely something. It's a data point that carries some statistical significance. In the opposite direction is when the S&P 500 records a gain for the month of January. That history suggests that the rest of the year will be up as well. And the same thing since 1950, and it's got an accuracy of 90%, 88.7 to be percent. When January records a positive return in the S&P 500, the year finishes positive as well. That's pretty incredible. Almost 90% accurate. When January is positive, the remainder of the year is positive. So what happened in January? This is being recorded the first day of February. If I have my numbers correct, we're close to almost a percent gain in January of 2017. So first 5 days and the month of January both recorded positive numbers. That implies that the remainder of the year is likely to be positive. However, we don't need to use it to predict. We don't invest based on that information. It's just a piece of evidence that we use and look at when we manage assets using the Adaptiv Investment Management System. So here's a topic du jour that everybody wants to talk about: President Trump and the market. Again, I don't want to get into too much political talk. I know people are exhausted of that, but I think it's important that at the beginning of the presentation I talked about the media coverage, the financial media coverage of the markets. So on one side of us, we've got the media providing sensational information that influences us, and then on the other side we have our own personal biases. So, and what do I mean by that? How can I be talking about President Trump and personal biases? Well, sometimes we like to tie ourselves to our investment self to our political self, and somehow it implies or has some type of we tie ourselves to it. Meaning, okay, there's some individuals who would say, oh, President Trump having whether it's a Republican president or Trump himself, that means great things for the market. Or a different person might say, no, it means terrible things for the market because of their own biases. And how can I prove that wrong? How can I say that that's a bias? Well, the data shows it. When we look at which party is better for the market, it really is a coin flip. When we look back to the mid 1800s, we can see that the average annual return under a Democrat president is about 7%, and the average annual return under a Republican president is about almost 6%. And whoever put this chart together at the Socionomics Institute thought it would be interesting to exclude the 1929 and 1932 period. I don't know why they would do that, because that was a pretty big period, but they're indicating if you omitted that, the Republican average is 7.68%. So no president or party has a monopoly on how the market's going to do. But yet our biases seem to lead us down that direction, that one party or president has more impact on the market. And I should clarify that, yes, there are ramifications to electing certain parties into power or certain presidents into power, and they affect regulations, they affect taxation. That's definitely true. But as far as markets, which isn't necessarily correlated to the economy, markets are not the economy, but when we look at markets and how they perform, they seem to be able to find, regardless of party, despite who is in power, where production is taking place, ingenuity and innovation is taking place, capital gets allocated to those places that are most efficient and providing the most value. And this happens no matter which party is in power. And this chart here shows that each group, whether Democrat or Republican, you can kind of see that's very similar. Now, what about Republican or Democrat controlled legislature? What about that? Same thing. Okay, so this is from Morningstar and Ibbotson. This is going from going up through, I believe, 2015, and here we have the same annual return, year-end annual return for Democrats and Republicans. So we can't tie ourselves to biases we have regarding this president or that president, this party or that party. So we have our work cut out for us when we're involved in the markets. We have the media on one side who may not have our best interest in mind, and we have our own personal biases and emotions on the other side that affect us when we make investment decisions. So looking at the road ahead, we're going to take a look at some sectors, what's going on internationally, and commodities to kind of give us a clue and maybe some insights on what 2017 may look like. So here's a chart that we took a snapshot of. This is right after the election through January 13th, which is what we had data at the time for. And this is an exercise we do as part of our process in managing client assets. And this is when you have big events like Brexit or a presidential election. Once they take place, it's as if a foot gets dropped, meaning it kicks up a lot of dust. And that dust resettles into areas where people believe there's going to be future return. So after the election, here we can see that most sectors, cyclicals, technology, industrials, materials, energy, and financials all up through that period of time, and yet consumer staples, healthcare, and utilities down since the presidential election. And this may, on its surface, you may say, so what? But when we look at these as a basket or group them, so there's something called high beta and low beta, or a better way to maybe describe that, because I don't want to get caught up in fancy terms or shop talk, but high beta simply means that if the S&P 500 moves 1 point, something that is high beta will move greater than 1 point. So 1.1, 1.2, maybe 1.5, and vice versa. So if the market or S&P 500 drops 1 point, those same high beta sectors or stocks will drop by more than 1. So it's both sides. Then you have low beta, which is the opposite, or low. They're also called low vol or low volatility if you hear it talked about on the news or publications. And those are these areas right here. These three that are down, this is low vol, that's low beta. So these are protective sectors. These are areas where if the market moves 1 point, they're going to move less than 1 point, like 0.9 or 0.8. And typically the other way, if the market drops 1 point, these areas will only drop 0.8 or 0.9. And so they're considered safe havens. They're low beta. And really, we're seeing these other areas outperform low beta. So high beta outperforming low beta. All that simply means is this is risk-on behavior. People are willing to take on, asset managers are willing to take on, since the election, increased risk. it's something to take note of. We continue to see industrials be an important part of how the market operates. This is something I showed back in quarter 3, and really what we're doing here is the S&P 500 is in the chart above. Down here, this is a ratio chart. This is industrials divided by the S&P 500. It creates a ratio chart for us. When the ratio moves up in value, it means industrials are outperforming the broad market. When it drops in value, it means the industrials are underperforming the S&P 500. And we can see pretty clearly when industrials outperform, it's good for the market itself. When industrials underperform, the market can be flat or down. And this happens over and over and over. We see industrials outperforming, market does great. Industrials underperforming, market is flat. And we're starting to see industrials take off again and outperform the market, and the market itself is doing well. What about internationally? What have we seen since the election? So this is the same methodology. We're looking at what happened after the election. In this case, this data is through January 17th, so maybe a little bit outdated. But here we can see the S&P 500 is up 5% during that period. The Vanguard, all world, and then this excludes the US, so this is looking at all the global stocks but excluding the US, up 3.9%. Here's emerging markets, 2.2%. Latin America got hit a little bit afterwards. That was interesting, down 1.3%. Europe, Asia, Far East, this is up 4.2%, and here we have Japan up almost 11%. So, and that's a really interesting story, that since the election, Japan being up that much. So we have some international growth here since the election. One of the themes that keeps on developing and not changing too dramatically, there was a little bit of some volatility directly after the election. However, this is another ratio chart. This is just showing Latin American stocks divided by the S&P 500. And when this ratio drops in value, it means the United States is outperforming Latin America, and that had been going on for a long time, since 2010 through 2015, early 2016, we saw that change. In 2016, we're starting to see Latin America outperforming the United States, so it's a place we want to be or consider being, is in Latin America, because it's outperforming United States equities. Commodities, same thing. We looked at it after the election, wanted to see if there was any insight from that, where the dust was settling. Here we can see, here's the CRB index, and really this is a heavily weighted oil index. So if you think about all the pieces of the pie that are in there, the biggest, almost half the pie, I wouldn't say that big, but very close, is oil within that index. Here's agriculture up 2.2, energy, so your oils, your natural gases, your heating oil, your gasoline, up like 17%. Industrial metals, copper, tin, aluminum, nickel, up about 4.2%. Livestock up 19%. And here we have precious metals like gold and silver down almost 5%. So it's interesting, we see agriculture and energy and industrial metals picking up. There's some inflationary aspects of here, and I think that's an important thing to point out, that what we're seeing is, if you can imagine trying to keep something boxed in that has a lot of energy, it produces a lot of energy, that pressing up against the lid. And here's the CRB commodity index versus the US dollar here on the bottom. And we can see, and this makes sense, that when the dollar bottoms and starts to rise in value, commodities drop in value. So when the dollar bottoms, commodities tend to top out. So when the dollar appreciates, commodities drop in value. That's typically the correlation, negatively correlated, the dollar versus commodities. But what we've seen since early 2016 is commodities rising and the dollar rising. And typically it's the opposite, one or the other. And when we see them moving together, something has to give eventually. We don't know when, but we know that eventually that positive correlation will break to a negative correlation. And if the dollar were to break down here and drop in value, it would be a tremendous tailwind for commodities to increase in value. It could happen the other way too. If the dollar continues to appreciate in value, it's probably unlikely that oil would hold $50. But right now we're seeing commodities pressed up right against that lid, and if the dollar decides to sell off, we could see some tremendous inflation within raw commodities, something that we probably haven't seen since the 80s. Lessons from the 90s, this is really important. I think this is a topic we need to remember when we participate in markets that are moving to the upside, when we're in a bull market, which is a market that's moving upward. What does that look like? So here's the S&P 500 going back to 1988 through 1998, and we can see that the market moves, it consolidates, and then it moves up in value. It consolidates, and then it moves. Consolidates, and it trends. And this is what our system identifies, these periods of positive trend. And I want to highlight this because I want to show you what does it look like. This 30, I'm going to focus on this 30% gain right here from 91 through 94. It's really important to identify. In this chart it looks really simple. Oh, that's a slam dunk, that's an easy 30%. Not necessarily, but the system does let us participate. For example, here's 1991. System is identifying that we're in a positive trend, but what does that look like? What does it look like to participate in the market in 1991? Well, since leaving that consolidation, there's a 14% gain, which is great. But in order to, participate in that, you'd have to experience these periods of volatility. 5 periods of anywhere between 3.5% to 6.5% drawdowns. So you're going to look at statements, or you're going to look online, and you're going to see that your account is down, but we're still in a positive trend and can participate in the market and need to be in order to capture these gains. And the system allows us to identify that. Because really, what is the difference between a bull market or a bear market? So a bull market is when the market's going up, and a bear market is when it's dropping in value. Honestly, if you just looked at green days and red days, meaning days that are up versus days that are down, they're about 50-50, a coin flip. It's the magnitude of those days that make the difference. So you might have a 50-50 split in both a bear year or a bull year, but the difference is how big are those green days or how big are those red days, and that's the difference. And we have to be able to identify when we're in a positive trending market and when we're moving up in value. So here's 1992, similar thing. Gain of 6%, yet there's these periods of drawdown, -6, -4, -5. 1993, same thing. Gain of 7%, anywhere between a 3 or 2.5 to 5% drawdown. So again, you're going to see the equivalent number of red days, but how big are those green days? And we're able to identify that using the adaptive system. Is when can we be involved in the market that has volatility and experience upside? And so here we have this period from 91 to 93, and it's a 30% gain, and it's not necessarily that easy, but our system allows us to participate in that. So where am I going with this? So this is the chart I showed from our Q1 market review back in 2016, and here this is getting back to we have a plan. This orange box of consolidation the S&P 500 was in back in April. We didn't know whether it was going to break up or down, but we had a plan for either one. The system allows us to be flexible and adapt. Here it is, October, and we've since broken out of that box in Q3. So we kind of had a strong indication, and the data confirmed, we're heading into a positive trend. We're leaving this area of consolidation. That's an important characteristic of trending markets. And here we are today, and as of this recording, this is actually maybe a little bit behind. We're a little bit higher than that. But we're up in this general area, but we continue to break out and see the market trend. No matter our bias, no matter what the media says, price is telling us that we're in a period of rising prices and a positive trend. There will be volatility. There'll be 5% drawdowns, 7% drawdowns, but we're in an area of positive trend. Same thing with yields and S&P 500. I showed this at our last Lunch and Learn in October, just pointing out, some would question, okay, if yields are rising, can the market actually do well? Well, that's the traditional relationship, really. When we see, for example, here's our example, 10-year yield. When we see that rising, S&P 500 would rise. The exception was this period here when yields in 2014 were dropping and the market kept going. Back in October, we were seeing yields break out. The market was breaking out. And here we are today, yields up big, market up big. And that's a characteristic that's normal. We shouldn't be afraid of it. So when the media starts covering rates, whether it's bond rates, which I'm talking about here, or 10-year yield, or they're talking about Fed interest rates, market can go up in a rising rate environment. So that concludes the presentation, and really, this is my chance to kind of give you an idea of what we do for our clients. If you're watching this and you're not part of our client first family yet, I highly suggest, or maybe you're a client that doesn't have a bucket plan, but it is a powerful tool that we use. It's a process that you can plug into to reduce that worry and have a goal stated and written down for you, and a plan going forward to reduce worry and increase your clarity as far as the future of your retirement. The Adaptiv Investment Management System, another process and system. We use it to stand between you and the markets. It's your emotional bodyguard. It allows us to be involved in the market when it makes sense and out of the market when it doesn't. And of course, tax season is coming up. I know tax season stresses me out, but it shouldn't. I know Renee does an awesome job, and her team of preparers. It's an important part of your financial plan and financial picture, your tax picture. It's one of the two major areas where you can have financial losses if you're not handling your taxes correctly. So if you need someone to take care of taxes for you, we're there to help, and Renee's team does an awesome job of that. It's really important to identify that big picture and how these different things plug in together to impact your financial picture. It can be one thing to have a bucket plan, but really all these things plug in together: investment management, bucket planning, estate planning, looking at how you're insured for auto, home, and life, 401k advice, or Social Security planning. All these things fit together and provide a big picture perspective on your financial well-being. And that's important to identify those situations and what your goals look like. And so when we present this information, when we have these different fantastic processes, whether it's the Adaptiv Investment Management Plan, our tax preparation services, or our bucket planning, really the missing piece is you. And I know in this illustration here, I've got peace spelled like it is because it's a peace of mind too. Not only are you plugging into systems, but there's a peace of mind that takes place when you surround yourself with processes and systems that work towards your advantage, work towards your financial goals and your retirement goals. Before we end, I want to make sure I take some time here to honor Sherry Johnson. She's our Director of First Impressions. She is moving on to the friendly skies and becoming a flight attendant, traveling the world. We're excited for her. We're going to miss her. She was great for our clients. Awesome team member, big part of Client First for the past few years. So thank you, Sherry, for everything you've done. We really appreciate you. You'll be missed. Tax season's right around the corner. Just want to highlight our coupon for $79 for those age 50 and older. You can get that special rate calling in, scheduling your appointment with us. The phone number is on the coupon. It's 262-335-1700. We'll send you a tax organizer to get yourself set for the season and go ahead and start the tax preparation process with you. Before we go, I'm going to give you a sneak peek at the February Lunch and Learn topic, avoiding cyber fraud. Here's me with a quick interview with Paul Zarling, manager and partner, who's going to be providing some great information on this important topic.
Hey guys, I'm here with Paul Zarling, managing partner here at Client First. For those of you who don't know, those processes and people that I were talking about in the video before. He's responsible for keeping those in line with our vision, both for us as a firm and for you guys as clients. Paul's going to be giving a lunch and learn here in a few weeks. And what's our topic going to be? What are we going to talk about?
Dave, we're going to talk about protecting and understanding cyber fraud and identity theft.
Awesome. So that's kind of a big topic.
It
An
is.
important one. Can you kind of give them a sneak peek or maybe some type of interesting fact that might draw them in, make them want to attend? We think it's an important topic, but what's some type of information you can give them that would be, wow, I want to hear more?
Yeah, it's a great question to ask, and it's really a $58 billion problem just in the U.S. A lot of you have heard about hacking, whether it was Target, Yahoo, Home Depot, etc. Unfortunately, we've had a couple clients get impacted by that, and we're able to help them out. But if you think about it, the average person has to deal with somebody lurking trying to steal their identity, and it costs you about $7,700 and about 30 hours of your time. So it's a big hassle and a lot of emotional stress. If you want to know how to detect it, defend it, or deter it, I've got answers for you on all three of those. We'll see you on February 15th.
Awesome. Thanks for that sneak peek. So there you have it. I'll see you at the February luncheon.